Hey all, welcome back to the channel. Today we are here to discuss Delta earnings and what it means for their stock price outlook. Before we hop in, please take time to like and subscribe if you would like to continue to see earning analysis and stock outlook. Now let's move on to Delta's earnings. Delta Airlines reported financial results that provided a broad and nuanced view of the company's recent performance, strategic direction, and the shifting dynamics within the air travel industry. For the quarter, Delta posted revenue of $14,610 million, a figure that came in slightly below analyst expectations, which were set at $14,720 million. Although revenue modestly missed consensus forecasts, Delta's profitability offered a more encouraging signal to investors and analysts, as the company reported adjusted earnings per share of $1.55, surpassing expectations that ranged from $1.51 to $1.54 per share. Despite this strong earnings performance, Delta faced a pronounced headwind during the quarter due to the federal government shutdown, which reduced revenue by an estimated $200 million. This revenue pressure emerged both from government employees traveling less and, even more significantly, from a meaningful reduction in flight availability caused by air traffic controllers being unavailable, which led to system-wide constraints that rippled throughout Delta's network. The most consequential development, however, was not found in headline revenue or earnings figures, but rather in the evolving mix of Delta's cabin performance. The earnings report revealed a milestone moment for the airline, as premium cabin revenue surpassed main cabin revenue for the first time. Premium cabin revenue increased 9% to reach $5.7 billion, while main cabin or lower cost seat revenue decreased 7% to $5.6 billion. This shift marks a major turning point not only for Delta, but for the broader aviation landscape, signaling that higher income consumers continue to spend robustly and are willing to pay for upgraded travel experiences, even as lower income consumers pull back after years of inflationary pressure and elevated costs across nearly all categories of everyday life. The strength in premium cabins reinforces Delta's long-standing strategy of focusing on travelers who seek elevated service, greater comfort, and enhanced loyalty program benefits, a strategy that has increasingly differentiated Delta from some of its competitors. Another key highlight from the quarter was Delta's update on its partnership with American Express, as the company reported that revenue from its American Express card program has reached $8.2 billion, with a long-term goal of growing this figure to $10 billion. This component of Delta's business has become a significant profit driver, providing recurring high-margin revenue tied to customer loyalty and spending habits rather than seat capacity or fuel prices. At the same time, Delta acknowledged a challenge that affected profitability during the period: rising labor expenses. Labor costs increased 11% year over year in the fourth quarter, largely driven by higher overtime levels and revisions to pilot contracts that increased compensation across the pilot workforce. Labor cost inflation has been a persistent theme for airlines as unions negotiate for higher pay following years of pandemic disruptions, heavy workloads, and staffing shortages, and Delta is no exception to this trend. Beyond financial metrics, Delta delivered a major update regarding its long-term fleet strategy. The company announced an order for 30 Boeing 787 aircraft, a significant decision given that Delta had been leaning toward Airbus for its new narrow-bodied planes in recent years. This shift represents a meaningful investment in next-generation wide-bodied aircraft designed to improve fuel efficiency, enhance passenger comfort, and support Delta's long-haul international growth strategy for the next decade and beyond. Looking ahead, Delta issued strong forward guidance that reflected both confidence in the company's trajectory and an acknowledgement of the uncertainties that continue to influence global travel patterns. For the full year 2026, Delta expects earnings per share to range between $6.50 and $7.50. This sizable range reflects the evolving nature of air travel, shifting consumer demand, and the macroeconomic landscape that continues to be shaped by pricing pressures, geopolitical factors, and supply chain complexities within the aviation industry. Delta also projected revenue growth of between 5% and 7% for the first quarter, a notably stronger outlook when compared with the 1% revenue growth achieved in the fourth quarter. Additionally, Delta anticipates generating full-year free cash flow between $3 billion and $4 billion. The company emphasized that capital investments will continue to be directed toward the expansion of premium seating, the area of the business that demonstrated clear growth momentum in the quarter and is increasingly core to Delta's competitive identity. Following the earnings call, Delta's stock initially traded down between 3% and 6% at the start of the day, though it ultimately recovered some ground to finish the day down approximately 2.5%. The movement reflects a mix of investor concern over rising costs and modest revenue performance, balanced against optimism about the company's premium strategy and long-term financial guidance. One potential challenge that Delta faces from a valuation standpoint is that its stock is currently trading near its all-time high, with a market capitalization of $45.3 billion. This naturally raises the question of whether Delta stock still has room to appreciate meaningfully from current levels, or whether the company is now priced near the upper bounds of reasonable valuation given its current growth rate. Several valuation indicators suggest that Delta is trading toward the high end of its historical range. The company's 12-month trailing price-to-earnings ratio is 9.7, which is lower than the ratio of 11 the company traded at during 2024, but still above its historical average prior to the global health crisis. Meanwhile, revenue growth remains somewhat subdued, with only a 1% increase in the most recent quarter. Despite these valuation considerations, analyst sentiment toward Delta remains overwhelmingly positive. 16 analysts currently assign a buy rating to Delta's stock, with no sell or hold ratings. The average analyst price target is $81 per share, which implies approximately 17% potential upside from recent trading levels. Even the lowest price target among analysts forecasts a roughly flat performance rather than a decline. Although these bullish projections signal strong institutional confidence in Delta's long-term trajectory, my own view is somewhat more conservative. I believe that the consensus price target is higher than where the company should reasonably be valued given its current fundamentals. A valuation range closer to $73 to $76 per share appears more appropriate based on revenue trends, cost pressures, and broader economic conditions. Given all of these considerations, my personal recommendation for Delta is to maintain a hold rating. If an investor already owns shares of Delta, retaining the position is reasonable due to the company's strong industry leadership, durable brand reputation, and proven track record of operational excellence. However, I would not actively seek to purchase additional shares at current price levels. Although Delta remains one of the strongest airlines in the world and is widely regarded as the industry leader in customer experience and operational reliability, the stock's record high price limits its near-term upside potential. My projection for Delta in 2026 is for stock appreciation in the range of 8% to 10%, barring major changes in economic conditions. However, investors should remain aware of the possibility of a more significant decline if the broader economy weakens, as consumer travel demand could soften and create headwinds for airlines across the board. For now, Delta appears well positioned, but current valuations suggest caution rather than aggressive accumulation.